Today, we're welcoming Emily Guy Birken to the show, author and blogger. She focuses on parenting and, most importantly for today's topic, money, with a mission to help people end financial stress. She has a way of making typically complex financial topics that we all know exist in the financial world. She helps make these topics very relatable and easily understood, which is what I found as I dove into one of her more recent books, which is why her personal finance articles have also proliferated the internet, appearing everywhere from Kiplingers to New York Times. And she has written 4 personal finance books, so Emily is actually one ahead of me right now. And she has a focus on one of her books, which we're really going to talk about mostly today, is the 5 years before you retire. So it's titled The 5 Years Before You Retire, Retirement Planning When You Need It Most. And this is what we specialize in at Howard Bailey Financial, is helping those that are getting ready to make that transition from pre-retirement to retirement and finding the right purpose and aligning those assets to defend that purpose at all cost. And I think it's going to be interesting today to get an outside of the industry perspective from Emily. And Emily, welcome to the show.
Thank you. Thank you for having me.
So Emily, I'm going to kick it off and dive right in, if that's okay, with a question that came from one of our fans that I think you've said that some people like to know. And, as I said, we're getting an outside the industry perspective from Emily here. And I think that's very important. One of the things I do with my spouse is every time I write a book, I hand it to her and say, hey, does this make sense? She comes from a medical background. And so if she can really understand what I'm talking about, understand the concepts and see how they can be applied, then I know I'm on the right track and I'm doing a good job with my writing. And you kind of have that outside the industry perspective, but also have the experience and the knowledge and the research to back it up. So my question here comes from Eric Todd. Eric said, where did she come up with her ideas on what to do 5 years before retirement? Does she have a financial background other than being a stay-at-home mother? So straight to the point, Eric.
Absolutely. So by training, I'm actually an English teacher. I have a bachelor's degree in English and a master's degree in English education. So right there, it's like, wait, what?
What? Yeah.
However, that doesn't tell the whole story. My father was a financial planner, and so I grew up in the industry. So I kind of absorbed quite a bit of financial information, like with my applesauce as a small child. And in fact, I've always been kind of a money nerd. So when my father would talk to me about money stuff, I actually was paying attention. Unlike other people might who are raised by people in the financial industry, they're like, yeah, whatever, Dad. So that is kind of where my interest began. So I was kind of a money nerd growing up. I've always been very interested in money and did some research even when I was working as an English teacher and other points in my life. So I made the pivot into becoming a financial writer right around when my first child was born. And it was not an expected career move for me, but we moved when I was pregnant with my child and I decided to take a year off. And so during that year, to just keep some money coming in, I started doing some writing and specifically some money writing. And that's why blogging was kind of my entrance into writing about money. And I found that my background in education and then, having my dad's expertise to kind of lean on, and then my own money interest has made me very good at writing about money, in that I'm coming at it, like you said, from an outside perspective. I know that there's an alphabet soup within the financial planning industry. And I know that can be intimidating to people who are outside the industry because I've got kind of one foot in both worlds. And so between that and the fact that, I really learned how to research with my background in education, and I truly love researching. And I for several years as an English teacher was making things that the kids thought were boring, interesting to them. I found that I can translate that directly to talking about money. Once I understand it, I can make it palatable and interesting and actionable for people who are outside of the financial planning industry, which can be really difficult to do. A lot of times when you've got the burden of expertise in some ways, you forget what it's like to be a newbie. So because I've got a foot in both worlds, I'm able to get that information to the people who most need it while making it a little bit fun even, which is something I really try to do.
Well, there's so many valuable things that you've said there, from being able to understand the research and also your educational background. I mean, those are the things that we want to accomplish is go back, research, understand what's going on, and then be able to communicate it in a way that everyone can understand. And one of the big problems in our industry, and I've suffered from this in the past, is we kind of turn ourselves into academics. We live it and breathe it every single day, from graduating with a degree in finance, becoming a CFP, getting a CLU, becoming an RICP, getting that alphabet soup that you speak about. And I'm always reading research. I mean, one of our podcast guests coming up is Dr. Wade Pfau, teaches at the American College on financial planning. And I mean, he's a researcher. He started Retirement Researcher, and I read that stuff day in, day out. We got Michael Kitzes that's going to be joining us at the beginning of next year. And it's a nerdy, I mean, he built his whole blog on being a nerd and a financial nerd. Yeah. And then we live and breathe that, and we kind of lose touch with what it's like to actually have to consume that information on the other side of the table. And I think what you've done is you've offered up the research and the facts, and not just that, but you don't have the bias, right? You're not there trying to sell a product or an investment or ultimately even get a client for that matter. You're just there to deliver the facts and the information so that people can make the best educated decision they can as they transition into retirement, or they're making decisions about Social Security. I think sometimes Social Security decisions, for that matter, are made because they say, well, we want you to take it early, and we want you to take it early because we don't want you to draw down your retirement accounts that we're charging a fee on. There's so many potential problems, no matter what type of advisor you're working with, a fee-only advisor or a commission-based advisor or broker, that it can be really refreshing, I think, to get somebody's perspective that doesn't have a financial incentive for you to make one decision or another. So I really appreciate that, and I've enjoyed your books.
Thank you.
I've read 2 of them now, so I'm 2 behind. I did pick up Making Social Security Work for You, and which it seems to be the topic of the day today. Everybody wants to talk about Social Security, and everybody's concerned about Social Security, especially our generation that completely writes it off as never being anything we're going to be able to use anyways. And so I want to get to that, but I really want to focus on the book that I enjoyed most, which was The 5 Years Before You Retire. And I also want to focus on that because that's a large part of the people that are listening are in that range. And I call this the red zone for retirement. So you're in the retirement red zone when you're 5 to 10 years before retirement, 5 to 10 years after retirement. This is when you can make or break your retirement. The decisions you make during this period of time, even statistically, and research shows, are going to make or break your retirement. So there's never a more important time for you to really dive in to your financial education, and never a better time to pick up a book like The 5 Years Before You Retire when you're 5 years out from retirement, right? So I think everybody's question is going to be, though, why 5 years, right? I mean, why not 7? Why not 10? Why not 15? Why not 2? Why not the year you retire? Why 5 years?
So 5 years is an important kind of benchmark before retirement, because that's when it becomes real. For most people's careers, retirement is kind of this, far off mythical thing. Like, you'll get there eventually, but you're not really thinking about it. So when you're about 5 years out, that's kind of becoming crunch time. You're like, oh, this is going to happen, and there are decisions I haven't made. Do I have enough savings? Do I know what I need to do to access my savings? Do I know where I'm going to be? And so that's when you really start thinking about like the logistics of retirement. Whereas like 10 years before, even 10 years before, even though you can kind of see it on the horizon, it's still enough time that people aren't really like, okay, I'll deal with this later. Within that 5 years, it becomes, the Stephen Covey important versus urgent. It becomes both important and urgent because there's not a huge amount of time left, but there is still enough time that you can make a big difference if you're behind, or if there are decisions you haven't made yet, or those sorts of things. Whereas if, 1 year beforehand, it's important and urgent, but it's a little too urgent and you
Sure.
might have missed the deadline.
Yeah, that 5-year period is when it becomes real. And I
Mm-hmm.
think, prior to that 5-year period, when you're 20, 30, 40, maybe you're 40 years old, you're 20 years out from retirement, or 15, even 10, you're at a point where it's not all that complex. You just
Mm-hmm.
see this line in the sand, which is
Mm-hmm.
60, 65 or 70, whatever that potential retirement date might be for you, and say, well, how much do I need to save? Right? How much do I need to save and ultimately retire? Well, you need to take X amount out of your paycheck every month and make appropriate investments, keep your
Mm-hmm.
costs low. However, you don't have to think about things such as Medicare and Social Security and rising taxes, making your income last for the rest of your life. What about inflation? Well,
Mm-hmm.
inflation affected you during your working years, but you got an inflation adjustment typically in your W-2 every year,
Mm-hmm.
or your salary. You continue to earn more during that period of time. Now, you've got a fixed budget that you're going to have to live on for the rest of your life. How do you inflation index that income? What about
Mm-hmm.
long-term care? It becomes very overwhelming for a lot of people within this 5-year period. And this is typically why they start to seek help during that period of time.
Mm-hmm.
Mhm.
Absolutely. It's recognizing that there's a new normal coming. After retirement, your life is going to have a new normal, and that's part of what I think happens within that 5 years. You recognize, oh, things that I've been taking for granted are going to change. So I need to figure out what those changes are going to be, so that I don't go into retirement unprepared and still taking things for granted that are not going to be true anymore.
Well, and some people call that new normal today, pertaining to what you talked about. But there's also the new normal period of potentially extended period of low interest rates and extended period of lower returns in the stock market than we've seen in the past. So, but that's a completely different podcast. We're probably going to have to get back to that at another time where we really dive into those kind of things. But I think, today let's focus on those 5 years before retirement and transitioning into that, as you call it, the new normal. What do you see that's different when you go from those accumulation years into your retirement years? How do you make that transition from one stage to the
Mm-hmm.
next?
So one of the things that I think people get very overwhelmed with is figuring out how to draw down their nest egg in retirement, because we have this sense like, okay, you save all this money and then you're going to live off of it. But we've got kind of the lizard brain view of money, in that, we think of it like, Harry Potter, where there's a big bank vault full of our money somewhere, and we'll just go and take a few coins when we need it. And it has to be more complex than that, particularly if you are at all concerned about market fluctuations. Typically the 4% withdrawal rule has been like kind of the gold standard of a safe withdrawal rate. But we've seen recently, now it's not as recently as it was, but in 2008, anyone who planned to retire that year could not use the 4% withdrawal rule. And so all of a sudden they're like, okay, how do I retire? How do I access this money? What do I do? And so that's something that I feel like people don't necessarily recognize. There are multiple strategies available, and that you really do need to think about how you plan to draw down your accounts as you approach retirement, so that you can make plans for, like, if there is a market correction in the year that you decide to retire, how you can still retire without, feeling like you're gonna have to live on ketchup sandwiches.
Yeah, and I think a lot of people, I mean, what you're saying is just making that shift from I'm growing my money at all
Mhm,
costs to give me an income that can last the rest of my life. And that
mhm,
sometimes we think of growth as income. Say, well, I made 7% a year on my 401k, and now I need to take 4% a year out.
mhm.
Why would that ever be a problem?
Mm-hmm, mm-hmm. Well, and that's, when things are going well, that works just fine. So one of the reasons why I am a big proponent of the bucket method for retirement withdrawal is because allows for things to screw up. It allows for Murphy's Law. So the bucket method is where you separate your money into different buckets depending on when you plan to access that money. So your first bucket will be for years 1 through about 5 or so. And so that will be in things that tend to be pretty stable. So, stable bonds, even cash equivalents, things like that. And so you can, if you have some money in that bucket and you are forced to retire during a downturn, or, things are just not going well, that you have enough to live on for the first 5 years. Then the second bucket would be for, let's say, years 6 through 15. And those can be in slightly more aggressive investments because that will allow you to let that money grow because you've got a longer time frame, about a decade, but not a hugely long time frame. So that's, bonds that are a little bit more aggressive, some safer stocks, those sorts of things. And then you can have a long-term bucket that is for years 16 plus. And in that way, if you use the bucket method, you can invest like a younger person. Whereas if you treat everything like you're going to draw things down like the 4% rule, then there is a point at which you have to be an old investor because you have to switch everything to bonds to be safe. Whereas if you use the bucket method and plan on that for your retirement drawdown, then you will have the opportunity to continue to invest like a younger person and see that growth from long-term investments and protect yourself as you get older.
Well, I'd say the reason I think the bucket method, or really not even just a bucket method, but just having some type of income strategy, the 4% strategy is not a strategy, right? It's just, I'm going to take 4% out every year and I'm going to increase it for inflation. And boy, I hope everything works out. And, previously when William Bennigan created that, there was it was ultimately safe max drawdown was about a 90 to 95% chance success with a balanced portfolio. But in reality, you go, well, what's that 5% chance that this doesn't work out? Is that another 2008? It's 2007. And that's just indiscriminately taking distributions from your retirement investments, no matter how diversified they are. You're just taking 4% out of each one. You don't have an actual strategy for where I'm going to draw that income from when the market's down. And I think the bucketed approach is one, or just simply having a place where we can go that we know is maybe some type of alternative investment, a place that we can go take a distribution from and know that it's not going to be down, or it's just going to be inversely related to something else that's in our portfolio. That's why we diversify during retirement, diversifying our income streams. Maybe it's real estate for that matter, but it's another place you can go while you wait for your equities to recover. And ultimately, investing is all about psychology, right? I mean, the reason retirement doesn't work out for many is because of panic. And if we say, well, a lot of people say, well, I get to retirement, I can't afford to take any risk anymore. Well, the reality is you are still going to be investing for maybe the next 30 plus years. So you have time, you just don't have time on everything. And if we have a place we can go, maybe it's that first 5 or 10 year bucket that we put in place that has some, protections or is more conservative for that matter, then we know, well, hey, the market's down 50%, but I don't need to touch that money for 20 years. And I can wait for it to recover just like I did during my working years. I think ultimately it's largely about psychology. And if we don't have that degree of understanding of we're going to be okay, then we will ultimately panic.
So I think you're absolutely right. I mean, I think a lot of the reason why the 4% rule is so tempting is because it allows people to feel like they've got a strategy without having to think too much about it. Because a lot of money decisions are based on like, what can I do so that I can ignore my money? And that's
because it's overwhelming, right?
Yes,
This whole retirement planning thing can be incredibly overwhelming with all the different topics and all the noise that's hitting you from every single angle. Really even, most publications, most financial articles, most things you hear on the radio or TV, they're all so biased that it's so difficult to get an unbiased opinion that now you hear, well, annuities are horrible. Annuities are great. Life insurance is bad. Long-term care is bad. Long-term care is good.
Mm-hmm.
Well, who's right and who's wrong, and how do you possibly discern that? How do you help people overcome that feeling of just being overwhelmed,
Mm-hmm.
and how do you help them with that?
So one of the things that I try to do is I try to remind people that they're smart and they can understand money. And one of the things that I want to remind people of is that they've learned other skills that have actually higher stakes before this. So if you cook at all, if you cook something wrong, you can kill somebody. But people don't have the
True.
same kind of just absolute fear of cooking wrong. That's not to say, I mean, I've met people who are cooking phobic. But in general, people are like, yeah, I can cook. I can, it's no problem. And so it's the same way with money. People have this phobia about money, like, oh my goodness, I'm going to do it wrong. But with money, yeah, they can have devastating consequences, but you cook something wrong, you could kill somebody. So
Well, that's why we follow a recipe,
yeah,
ultimately, right? I mean,
exactly.
and that's what's going on when you're cooking. You first start looking, or you
Mhm.
first start watching. I mean, when I grew up, my grandmother taught me to cook for the large part. My dad, my grandma, and I was always in the kitchen, always watching them do what they
Mhm.
did, and that's how I learned to cook. But then I started following some recipes, getting a little bit
Mhm.
more sophisticated, and I think we can kind of do the same thing with our retirement, right? We can
Mhm.
talk to others that have already been through the process and get a feel for what not what advisors are recommending, but what other baby boomers or other retirees are doing,
Mhm.
especially if they've been in retirement for 20 or 30 years, finding out, well, what worked for you and
Mhm.
what did the good times and the bad times feel like. And so you get that kind of education around the kitchen table or around the kitchen
Mhm.
like I did. And then you could also find a framework or a recipe that
Mhm.
ultimately gets you where you want to go. And that's what we try to do when we establish the purpose-based retirement strategies is, put together a plan that isolates the things you can control, right?
Mhm.
What can control? You can control your emergencies. You can control your income and your expenses. You can control your risk and your asset allocation. You can control your long-term care protection, and your tax strategy. And so now we've got a framework that is, here's the 4 risks you're going to face: emergencies, market downturns, inflation, and healthcare, and taxes. So here are the 4 different risks, and now we just need to find out how much we need to allocate to each one of those, put those risks so that we can most efficiently accomplish that specific goal. And
Mhm.
I think that's largely because I think there's new obstacles that baby boomers are facing today that previous generations didn't, which is making this recipe and this
Mhm.
education prior to retirement more important than ever. What do you see as the new obstacles that baby boomers are facing that are maybe different from what their parents faced?
Well, I think there's 2 aspects of it. One is the greater longevity, and it's a good problem to have, but it can also be devastating. The greatest tragedy is not necessarily that you die young, but if you outlive your money, can be really, really difficult and tragic on a day-to-day basis. Um, so that's something that, baby boomers' parents didn't really have to worry about. They certainly had longevity on, for individuals, but as a generation, they did not live as long. So that longevity is kind of a double-edged sword. I mean, it's wonderful to be able to enjoy a long life. It can be really, really devastating if you don't have enough money.
Well,
Um,
retirement's a relatively new concept, right? I
yes,
mean, it's
yes.
really not something that our parents and grandparents really had to plan for. A lot of them had pensions and they had guaranteed income. They had their
Mhm.
Social Security, and a lot of that took care of most of their needs as they stepped into retirement. And now we've got retirees that are still retiring at the same age as their parents.
Mhm.
However, their longevity has increased dramatically. I think
Mhm.
I saw a statistic the other day. I interviewed John Leland about his experience with interviewing people over the age of 85 to 104. And one of the things he said was, today's 85-year-old had a life expectancy of I want to say he said 66 years old when they were born.
Mm-hmm.
And you look at how much further, they've lived well beyond their original life expectancy. And I think that is only going to continue to become more and more a challenge in the future as we have more and more more improvements in the healthcare system and just the way we treat our bodies. And so you have to, I absolutely agree that longevity is one of the main issues that this generation is facing that other generations didn't. Just one of many.
Yeah. And then added to that, I mean, kind of it goes hand in hand with that is the cost of healthcare in retirements. So Fidelity does a study every year of how much a 65-year-old couple retiring in that year can expect to pay for healthcare costs over the rest of their lives. And for 2018, I believe it's $270,000. And what's so concerning about that is that 65-year-old couples are both eligible for Medicare. So that is, on top of Medicare covering what Medicare covers.
And we're only talking about a slice of the pie, right? I mean,
Yes.
We're talking about things that Medicare doesn't cover, traditional health care. That doesn't even begin to broach the subject of long-term care, home health care, assisted living, nursing home care. And those costs can easily turn into six figures annually. And they're only increasing, at about twice the rate of inflation. So those are really concerns that previous generations didn't have. You might say, well, I'm really healthy and I won't need I won't need long-term care because I take such good care of myself, but that might be exactly why you need long-term care in the future is because you've taken such good care of yourself. Now you're in a position where you continue to live, but you might lose your cognitive ability.
And it's, this is also part of this change in our social structure over the past 100 years. So, retirement didn't used to exist. You'd work until you couldn't work anymore, and then your family would take care of you. And we are now at a point where that's not the expectation anymore. Absolutely, you see parents moving in with their adult children and things like that, and families do try to help each other. But now that the two-income family is the norm for married couples, you no longer have someone who is able to help take care of grandma if she's no longer able to live independently, and those sorts of things. So this is with every step forward in one area of our lives, the social expectations and culture and things like that, you get a different step backward, an unintended consequence that, we didn't think of. So, and that's kind of what's going on here is because retirement has become an expected part of our lives, we have these expectations for what retirement should be, but we no longer have, the safety nets, the just kind of family and social safety net in place to help people who might not have saved enough for retirement or who are dealing with a cognitive functional issue and can't live alone anymore, and those sorts of things. And so that's that each generation has to solve a new problem. And I think that's the current problem that we need to solve.
Well, I really enjoy that. And each generation has a different problem to solve, right? Because we often say, well, this generation doesn't have this one is worse off than the last, or this one's better off than the last. We make these generalizations, and it's really just a different obstacle for a different time in history. So you covered healthcare planning in your book, The 5 Years Before You Retire, quite extensively. And you also covered budgeting quite extensively in the book. I really enjoyed the budgeting part of the book because I think that's one of the most difficult things for retirees to do, that most of them have never built a budget. Now they have to have one. And before we get into budgeting, though, let's talk about that healthcare aspect. Being that it's such a challenging thing to predict. It seems like there's just major changes going on in healthcare every single year. How someone that's going to retire at 65 or 60, whether they need to get a traditional healthcare insurance policy prior to 65, or they need to go on Medicare, we can kind of budget, I think, for Medicare for the large part. We've got some good statistics and some good numbers, but most people don't know what their health insurance premium is going to be if they go off their employer plan. And they also don't know what it's going to be at some point in the future. How do you budget for healthcare insurance during retirement, and especially prior to 65?
So it's a tough question to answer. When I wrote the book, it was just after the implementation of Obamacare. So, I was able to say, like, these are what the options are going to be. And now things are up in the air. We're not sure what's going to be happening with the ACA. And so that makes it difficult for anyone who is looking to retire before age 65 and is therefore not eligible for Medicare. So as for how to budget, it's one of those things where, like, you have to take your own health into consideration. And you also have to recognize that you may be better off continuing to work until you can reach Medicare age than trying to game the system. Well, that's a bad way of putting it, but trying to just make it until Medicare. Just for instance, I had a neighbor who retired early, and he was just going to, grit his teeth and bear it until he got to 65 for Medicare. Well, unfortunately, he ended up getting cancer and passed away. I can't fault him for making the choices he made. He wanted to retire. He was ready to be done with his career. He had worked as an attorney, and so had plenty of money. But when he started feeling ill, he didn't go to the doctor. And I think it's because he knew it was not going to be good news. And he was just kind of hoping he could make it. And that's a tragedy. It should not, our system should not be set up that way. But knowing that it is, you need to make the most practical, best choices for your health. And often that might mean if you need to continue working, even on a part-time basis, to keep that health insurance, or if you can find a way to be on a spouse's health insurance, so that you know what to expect financially from your health care. Because again, you might find you just don't know what you're going to be spending, and you might be overspending in those 5 years between 60 and 65. And so that's something where it's just a shame that has to be a part of someone's decision-making process for when to retire, but it is something to consider.
Well, as far as health insurance goes, I see a lot of the clients we're working with deferring retirement until 65. More and more are deferring retirement until 65 because of the unknowns when it comes to traditional healthcare coverage. And then we also work with people that are retiring at, say, 55 or 60. And so there'd be 5-10 years out from Medicare age. And during that period of time, you'll go out and get quotes. It seems like a lot of times, I just don't know how much it's going to cost. I'm too overwhelmed. How am I ever going to afford this? I just continue to work. And I've seen families that have done that, and they could have retired. They could have retired 5 years prior and paid for their own health insurance, but they didn't realize how much it was costing. Maybe their employer was covering half of the cost, and maybe we can even get them in a position due to good tax planning that they get subsidies that can help cover that insurance. So I think you have to know the facts and then build a buffer in place to cover those premiums where you say, well, it's going to cost me today $20,000 a year for health insurance. I'm just throwing out a number. It's probably not going to cost that much, but let's say it's 10,000, 20,000, whatever it is. If it's 10,000 a year for the next 5 years, it's $50,000, and you set that aside. So, I'm going to set aside $50,000 to cover health insurance, and you know what? I'm going to increase that by 25%, just to make sure if premiums go up in the future, I've got a plan for that. I just hate to see people that have put off retirement. I've got a couple that I've worked with that have over $10 million saved for retirement. They are, 55, 60 years old, and they are continuing to work because they are afraid of what health insurance premiums are going to cost. And if it costs them 50 grand, even 100 grand, wouldn't that be worth your time? I think one of the things we have to make sure we understand when we're 5 or 10 years out from retirement, if we can afford to retire and we don't do that, if we've got more than enough saved to cover all of our potential needs and we don't retire, now you're putting yourself in a position where you're working for someone else. You're not working for you anymore. You're working for your heirs. You're working for your children, your grandchildren, maybe the church you want to leave your life savings to. And that's just because you haven't sat down, you haven't put a plan together and said, you know what, I can afford it. At the end of life, when you're 90 years old and you said, boy, if I could get back 5 years of my life, how much would you pay? Would you pay $50,000 to get back 5 years of your life? Most people would say yes.
Absolutely. It's really all about knowing what your options are, knowing what it is that is available to you, and making educated conjectures about like you said, in case premiums go up. And because things are a little bit up in the air right now, it's the folks who are planning on retiring in the next 5 years right now are in an unenviable position because they don't know. So it's understandable, even if they're, your couple who has $10 million saved, it's understandable that they'd be like, I don't know. Yeah. So, you always want to base your decisions on the most rational possible decision. You want to gather the facts. You want to figure out what are you doing that's an emotional decision. What are you doing that is like actually rational about what it is that you want going forward. And with healthcare, it can be so scary, and that can cause a lot of irrational decisions in both directions, where someone's like, oh, I've always been fine. I can just grin and bear it until 65, like my neighbor did. Or, on the other side, like, I'm terrified. What if there's a cancer diagnosis or an Alzheimer's diagnosis or something. So I got to make sure I have health care. And when it comes to health, I mean, that health and money are two of the most emotional personal decisions you have to make.
Yeah, and they need to be made rationally. Yes. However, they're emotional decisions, and it's so hard for people to overcome. One of those emotional decisions in that, along the lines of that healthcare discussion, is long-term care. And you covered that extensively in your book. You talked a lot about long-term care and who needs it. And I cannot remember the last time I had a meeting with a family that was getting ready to step into retirement that didn't ask, what are your thoughts on long-term care insurance? So, Emily, what are your thoughts on long-term care insurance?
So long-term care insurance is you purchase insurance generally when you're a little bit younger, and you have it in place in case you need long-term care. Like, for example, someone with dementia or Alzheimer's could otherwise be perfectly healthy and so not need medical care, but need daily care with things like dressing, cooking, getting around, those sorts of things. And so, the cost of long-term care can be devastating to a budget because it is not in any way, shape, or form covered by Medicare. So it's this comes down to a numbers decision. There is, I think, it's something like 40% of retirees would benefit from having long-term care. The rest are either in a financial position where they have enough money that they can self-insure, basically, not long-term care insurance. So 40% of retirees are in a position where they benefit from long-term care insurance, because the rest are either in a position where they can self-insure because they have enough money that if they do need long-term care, they can pay for it out of pocket and it will not affect their quality of life too badly. Then the rest are in a position where the cost of long-term care insurance premiums would be far too much for them to be able to take on. And so it would make more sense for them to just completely deplete their finances if they do need long-term care, because at that point they could become eligible for Medicaid, and Medicaid does cover long-term care. Now, obviously, that is not what you want to happen if you're in that group. However, if you know that you can't afford long-term care insurance premiums, that is the rational roll of the dice. Like, all right, it makes more sense to just plan on depleting my savings and going onto Medicaid if I do end up needing long-term care, rather than depleting my savings by paying for long-term care insurance premiums and find out I don't need them.
Well, and I think today there are so many different options for achieving that coverage for long-term care that most people dismiss long-term care insurance and say, well, I don't even want to look at it because I don't want to pay for something I may or may not ever use. Even if there's a 50% chance that I'm going to ultimately use that long-term care policy, yeah, 50-50, I'll take my odds, even
Mm-hmm.
though it's a higher percentage of odds that you use that insurance policy than it is
Mm-hmm.
that you have a house fire or a car accident. You still
Mm-hmm.
end up avoiding the one of the biggest risks typically to your retirement because of that use it or lose it
Mm-hmm.
part of long-term care insurance. And a lot of long-term care insurance premiums have skyrocketed
Mm-hmm.
for policies that were put in force 10 years ago. But today, there's so many different options. Even if you're
Mm-hmm.
uninsurable, you can still get coverage. And
Mm-hmm.
I met with a couple today that had that situation. One of the two of them, they were in a position where they were in a situation where they had about $1.5 million in investable assets, and they had some good pension and Social Security, but they were kind of in that sweet spot where they say, well, it could be devastating, right? I
Mm-hmm.
might be able to self-insure, but I'm only going to be able to handle a couple of years. If it ends up lasting 5 years,
Mm-hmm.
then we could end up in a very difficult situation for my spouse typically. And so they really wanted to focus in on that because they would have been fine outside of that major risk. Everything
Mm-hmm.
else, we just protect their life savings, make a decent rate of return. They've got enough money to last the rest of their life, but long-term care could take it away. She being insurable rather than buying a long-term care policy because she did not like the idea of use it or lose it. And
Mm-hmm.
so instead they were saving $10,000 a year in a savings account at the bank. So instead we said, let's take that $10,000 a year, put it in a whole life policy. And now you can have back that those funds we'll put in there over 10 years. We'll put in $100,000. They can have it back if they want it back. They have a death benefit that they can leave behind to their heirs. That's tax free. That's about $150,000. But if they ever need long-term care, they've got $500,000 in long-term care benefits for her that they
Mm-hmm.
can use. Well, that money was just going to sit in the bank otherwise. So
Mm-hmm.
why not go ahead and pick up some coverage? And it's
Sure.
not use it or lose it, and they'll never see their premiums increase. For him, on the other hand, he was uninsurable
Mm-hmm.
due to a previous heart attack that he had. No long-term care carrier was going to take him
Mm-hmm.
as a risk. He had the pacemaker. Right. So he had a
Mm-hmm.
pacemaker and he had a heart attack. And so we ended up looking into an alternative where he could set aside a portion of his savings. We'd set aside around $300,000. We could make 3 to 6%. So it's still going to grow. They didn't need it for retirement. So it's
Mm-hmm.
still someplace they can get at it if they want it. Now they've got an income benefit that would create about $15,000 to $20,000 the first year. It's going to increase every year and it
Mm-hmm.
would double if they needed home health care. And if they
Mm-hmm.
never used it, there was a substantial death benefit to pass on to their heirs. So in instances like that, you might not realize that there's so many other options out there for
Mm-hmm.
long-term care coverage. And for those that say, I'm just going to self-insure, look real hard at your assets, I would say,
Mm-hmm.
and see if there's a chunk of money that's sitting in a savings account, sitting in a CD, that's sitting in an IRA and money market, that could be reallocated where it can
Mm-hmm.
earn a little bit higher rate of return or at least the same, but pick up some long-term care benefits.
Mm-hmm.
Just so many other options out there today.
Well, and that's that I feel like is the main thing is knowing what the options are, taking the time to think it through. Because a lot of times, again, this gets to that psychology of money where people don't want to think about it. And thinking about mortality, I think, is actually even easier than thinking about if you lose independence. So, we all know that we're going to die. We like to think like, oh, but I'm going to be, sharp as a tack right till the end. And it's really hard to think about if something were to happen, if you have a stroke or we're diagnosed with dementia or something like that. People hate to think about that, which is completely understandable in human nature. But because of that, I think that there's kind of this difficulty in looking rationally at long-term care insurance and the options for long-term care because people don't want to think about the fact that they might need it.
Yeah, we don't want to think about the end of our life. That's why
Yes.
so many have the wrong beneficiary designations, avoid putting a will in place, end up
Mhm.
with probate assets, and it sometimes, believe it or not, end up with assets that pass to an ex-spouse even because they just
Yeah.
didn't want to think about death and change their beneficiaries. We just don't want to think about those things in finance that can be even major market downturns. Sometimes we just close our eyes, put the blinders on and say, I hope everything works out.
Mhm.
You don't have have to do that. You can put together a plan. There's a couple topics that I really enjoyed in your book. One being budgeting. So I want to make sure we talk about budgeting, which there's nothing more important than budgeting when you're talking about retirement, living on a fixed income. Then we have some questions from some of our fans on Social Security. And heck, I am looking at a book that you wrote that's 250 pages long on Social Security. So I would say that we have to get to a couple Social Security questions. But first, let's talk about budgeting. We often hear there's nothing more important in retirement than income, because if you don't have income, you don't have retirement. However, I'd say even more important than that is putting together a budget, understanding your expenses so that we know that we have the right income. It has to start with a budget, it has to start with understanding our expenses so that we can put together the appropriate income strategy to satisfy those expenses. So how do you, as I said, many times we're stepping into this new stage. We've never put together a budget whatsoever, especially for someone that's maybe had a substantial income and they've never really had to worry about money, or they just slap it on a credit card and they'll put it on overtime, put some overtime in over the weekend to pay for it, a home equity line of credit. So we can't do that necessarily in retirement. And it can be very overwhelming. It seems to be when I sit down with someone that's never done a budget, I don't even know how to do a budget. It's scary. How do you simplify budgeting for the newbie?
So to simplify budgeting for the newbie, the first thing is you need to kind of deconstruct what they think about budgeting. Like, people hear the word budget and they think deprivation.
Right. Can't spend any money.
Yes.
Sure.
So, and instead you need to think about it as like, what do you want to do? So if you start your budgeting journey with like, what do you want to be able to afford? And so let's say, well, I want to be able to fly to see all my grandkids in all four corners of the U.S. Twice a year. Okay, great. That's a great first start. We know that you're going to need, it costs about $300 to fly round trip. You're going to need about that 8 times because you've got, 4 sets of grandkids each year. So, okay, so that's your first line item on your budget. Now, that's going to eat up quite a bit of money. So what can you cut? What do you not care as much about? You've gotten in the habit of dining out 3 times a week, but let's say you reduce that not all the way, not even just no times a week, once a week. How much money does that free up? And so that's really what budgeting is more about. I like to think of it as like a big Tetris game with your money. So you are trying to make things fit, and you start by identifying what is most important to you. What is it that you need to have to feel like you're having an enjoyable and fulfilling retirement? So start with those, and then from there you can make the choices of where the trade-offs, where like, okay, well, I don't need to do this anymore. So because maybe you really enjoyed clothes and you always bought new clothes while you're working, so you can still enjoy clothes, but it's more important to you to see your grandchildren. So you can slash your clothing budgets. Still be able to look good and enjoy new clothes maybe once every season instead of once a month. But knowing what is most important to you and identifying those things is really what budgeting is all about. And then once you've done that, you can play that kind of budgeting Tetris where you figure out how to make things fit. And from there, you can always reassess if you decide, I don't like flying that often. As much as I love seeing my grandkids. So maybe it's once a year for each set of grandkids. Okay, well, that frees up this amount of money. What else would I like to fill my time with? What else would I like to use that money for? So that's the other aspect of budgeting that people don't necessarily understand. It's not a once and done thing. It's a living document that you consistently come back to say what's working, what's not working, how can I rearrange things so that I feel most fulfilled with the way that I'm spending my money.
Well, I think it kind of follows a process that we like to share with the people that we meet with when they're first trying to put together this budget is let's dream, right? Let's sit down and think of all the really cool things that you would love to do while you're in retirement. You want to go on a cruise with all the children? Do you want to have a new fancy car? Do you want to have a second home? What would the perfect retirement look like? and then let's see what fits in the budget. But I really like how in the book you help people prioritize those things. In the book, you had a little worksheet that I found really interesting. It helped people prioritize their needs and their wants in order to help them minimize their expenses. And you'd brought this up after mentioning David Bach and David Bach's talk about buying coffee. Right? Can you talk to that worksheet and your thoughts on David Bach?
So David Bach coined the latte factor. So his point about the latte factor is that you end up spending a lot of money without thinking about it on little purchases like a daily latte. And David Bach is a colleague of mine, so I got to be careful. I say that I hate the latte factor in the book, and it's because I don't have any quibble with the math or the fact that there are some people out there who are spending money without thinking about it on their lattes. My quibble with the latte factor is the fact that generally people who are spending money mindlessly on little things are also spending money mindlessly on big things.
Yes.
And it is a lot easier to figure out where your big money drains are than it is to keep track of the $5 every day you spend on a latte and put that in the bank. Whereas spending a big amount of money on, let's say you lease a car, and that's a big money drain when you could afford a used car for cash, and that's going to save you a lot more money and much more easily and quickly than trying to figure out where $1,300 is going every year because you're buying lattes every day.
Yeah, and you kind of worked back into that worksheet from there, which helped list out each one of those expenses. And once you've listed out those expenses, I think you had it rated on a scale of 1 to 5, or maybe it was 1 to 10, so that you could see which one of those were most important to you. And then that allows you to kind of rearrange that budget and play a little Tetris, right? So, I don't really like that block. I thought I liked that, but this is much more important to me. I think that's the one that I want to make sure we have in retirement. That's the expense that I want to make sure we hit. And to your car saving, your car point, you had a really neat, just simple math, really, but a way, a lot of times I think we say, well, we're going to get rid of a car and we're done. However, you had shared that, it's not just the car, but adding up all the other things that go along with it. As you sometimes are in your working years, you have to have 2 cars, then you retire, you may be down to 1 car, and it's not necessarily we have to cut our expenses with a car, but just to realize how many other little things go along with one expense like that. You had car payment, insurance, gas, maintenance, and then multiply it by 12. That's your yearly savings, and you do that with a lot of different pre-retirement items and how those things are going to change once you retire.
Yeah, there is a cost to working, and that's something I think that again, one of the benefits of coming from a non-financial background, because I took a year off from teaching to stay home with my son. It was one of those. Part of the reason why I did that was the amount we would pay in daycare was going to almost eat up my salary as a teacher, and so that's there's this cost to working that we don't necessarily think of unless we're in early parenting or right after we finish our career and start retirement and realize, oh, I'm not going to the dry cleaner every week. I'm not eating lunch out 3 times a week, and it's, you don't necessarily think of these things because they fold so seamlessly into your work life. And because you are working, you are able to cover those costs. But that's something that it's important to think through is like, how will you save money by retiring? Because there are ways that you will save money that you may not have thought of prior to getting there.
Yeah. Now, I think we have to make sure we touch on Social Security because we did have a lot of questions that came from our fans on Social Security. So I want to make sure we get to those things. And I think before we even get into there, a lot of folks don't believe Social Security is going to be around for their entire retirement. What are your thoughts on the sustainability and the security of Social Security?
So there's two things about Social Security that I think that people don't know and need to know. The first is that the United States is the only country in the world that does a 75-year projection of its social insurance programs like Social Security and Medicare. So that means that we know things are coming for a really long time. So we tend to get into the sky is falling a lot earlier. But that also means that we're in a position to make changes. And that's actually why, I mean, have already been changes. The baby boomers were a huge generation, and they were a surprise to the preschools and kindergartens when they signed up when they were 5 years old. They're like, oh my goodness, there's a lot of kids here. But when it came to Social Security, we're not surprised. We know that there's going to be, I think it's 10,000 people turning 65 every day. And so we know that's coming. There's their retirement is not a surprise. And so they made changes in the 80s as to when people like our generation can be considered full retirement age. So, and things like that to try to save some money. So that's something to remember. I think that our government tends to like to use Social Security as a political football. They like to argue about it. I truly believe that when the chips are down, they will make the changes necessary to make sure that it fulfills all of its promises. But
otherwise, they don't get elected again.
Yes, exactly. Social Security is also incredibly popular. So there's a lot of anguish and hand wringing about Social Security, and I think of that as kind of theater to get people upset. But I do believe that that when it comes to it, they will get off their high knees and do something about it.
Well, in the end, there will be changes without a doubt. And I think what a lot of folks don't understand is, yes, while there are problems with Social Security funding, they're not actually all that difficult to fix.
Yes.
There can be some minor changes, even to just payroll taxes that can quickly fix the underfunding problem that Social Security has. So I think we have to believe that it'll be around. However, there will be some changes. And maybe those are material changes, but whenever changes have been made to Social Security, they have been sunsetted. And so, younger generations, maybe you're 35 years old. Well, if you plan on taking Social Security at 62, you may not be able to. Maybe they push that age back to 65. Maybe it's 70. There are ways that funding can be fixed without taking it away.
Yes, absolutely. The other aspect to remember is that so people get very, very concerned about the Social Security Trust Fund. And the thing to remember is the trust fund was put in place because there was more revenue from payroll taxes than there were needs at the time. So the trust fund was put in place because they needed a place to invest the money. I also get a lot of people saying like, well, Congress raids the trust fund. Well, no, that's not true. When anytime you invest money, it is immediately being turned around and loaned out. So if you put money in a savings account at your bank, there's not actually a pile of money in an account with your name on it. What's happening is the bank is loaning it out to for mortgages, for small business loans, for personal loans, for car loans, that sort of thing. And same thing happens with the government with the trust fund. When payroll taxes go in, then the money is loaned out to different government programs, and it earns interest in the same way that any kind of investment does. So that's something people get very, very concerned about that. Now, we are depleting the trust fund right now, and it should be completely empty, I believe, by 2033. And that is a worrisome thing because at that point, we can only fulfill 79% of what is currently promised.
Yeah, given current tax revenues.
Yes.
I mean, it's not that, just because there's nothing in the trust fund doesn't mean there's no longer any revenue coming in to satisfy distributions. It just won't continue to grow.
Yes.
Think about it as, if you're to say you're getting a pension, right? You don't have any more savings in your account and you're spending your pension every year, but it only covers 80% of your spending needs. I think that's a kind of a similar analogy we might be able to use.
Yeah, and it's so it's something to keep in mind. It's like there's a lot of hyperbole about Social Security, but it's actually set up in a way that is actually very beneficial in that, current workers pay for current retirees. And so that means unless there is some kind of, global phenomenon where nobody's working, in which case we've got bigger problems than Social Security. There will be something there for us. And the only other way that Social Security could go away is if the United States decides to do away with it, which again, I can't imagine happening. Now, there are likely to be changes. When I wrote the Social Security book, I turned in my manuscript, I believe it was like 8 days before Congress made a change to Social Security, which affected about 50% of what I had written. So I don't want to complain because that was a minor thing for me, really. I had to rewrite the book. There were some people who that very negatively affected their retirement planning because they were just on the wrong side of the deadline for their birthday. And that's a much bigger problem than me having to rewrite some chapters. But those are the sorts of things where I want people to know Social Security will be there, but don't make long-term plans based on any particular aspect of Social Security.
Oh, yeah, so many people that had planned on filing and suspending and all these, fancy kind of really loopholes that could be used to maximize your benefits have kind of gone away. But people that had planned on doing that had to revamp the retirement plan. This is why it's so important to have a flexible retirement plan so that you can make changes that will inevitably occur over a 30-year retirement. I'm sure we could stay on the Social Security topic for a whole hour. We might have to save that for another episode. I'd like to use our last few minutes here just to cover some questions that I like to ask at the end of every podcast. That gives us a better insight into you and some of your principles and some of our most interesting answers come out of this segment. And my first question is a question that I've literally asked thousands of people, and it seems that most people have a different answer. And someone such as yourself who studies retirement, researches retirement, writes about retirement, in one word, what does retirement mean to you?
Freedom. So I don't have plans to traditionally retire. I love writing so much that I know that even when I'm retired, I will still be writing. For me, getting to retirement means getting to the freedom of being able to choose the projects that I'm most interested in, rather than, there's I've been writing for 8 years now, and I'm interested in pretty much everything I do. But sometimes I write similar articles over and over again. It feels like Groundhog Day somewhat. So having the freedom to choose the specific projects I'm most interested in retirement, and having the freedom to say, I'm going to go for a hike today instead. That sounds like what retirement is going to mean for me.
Well, I think a lot of, especially self-employed individuals, business owners, really love what they do. And they'll say, I never plan on retiring, so why do I need to meet with the retirement planner? I'm not planning on retirement. I'm 60 years old. I'm going to work till I'm 80. I think there's multiple reasons to do that, though, and the biggest being freedom. One being that you could be forced into retirement, whether you want to retire or not. But freedom is such an important word there because, once you get to that stage, I've worked with business owners that said, I've got one that I worked with that said he never wanted to retire. He was going to work as long as he possibly could. And he was planning on, he had sold his business and he was planning on getting started into another business. But he said, I just want to make sure that if I don't like that new business I get involved in, or someday I just decide I want to quit, or if I decide I don't want to go to work that day, I've got a plan that gives me the income and emergency fund and inflation protection. I want a plan that I can fall back on. And you wouldn't believe I think the things that he's working on today could potentially change the world. And he wouldn't have that same opportunity because he wouldn't be able to take that same degree of risk with his life and really his financial life if he didn't have that plan to fall back on. I had a mentor of mine that once said, figure out your number. Once you figure out that number, once you get to that number, get there as quickly as possible. It doesn't have to be 65. It could be 40. It could be 25, whatever that number might be. You get to that number and you'll live your life completely differently. You'll treat the people in your life differently. You'll treat your business different. You'll treat your employees different. And that's where you can really make the biggest impact, biggest positive impact in the world.
Mm-hmm.
So
Mm-hmm.
my next question is, what is something you would like to see as absurd 25 years from now?
I would like to see people staying in a job they don't like for the health insurance is absurd 25 years from
Oh,
now.
I like that. Yeah.
Um,
How much do people hate to stay in a job because
yeah.
of health insurance?
Mm-hmm.
Now, I think we've got a long ways to figure out how we're going to get there, but if we get there, that would
Yeah.
be really nice. That's a
Yeah.
great answer. And my last question is, if you could revisit your 20-year-old self, what kind of advice would you offer?
Whew, I would tell my 20-year-old self to take a couple of courses in economics. I double majored in English and French literature with with a focus on creative writing, and I loved it. I mean, absolutely loved it. Would not change a thing. But there's a lot of stuff that I've had to teach myself about both micro and macroeconomics that I would have found interesting back then. I just was woefully literary as a 20-year-old and would not have heard, like, couldn't imagine being interested in this, even though, I've always read like sociology books that kind of like bordered on like things like behavioral economics and stuff like that. I read those for fun, even in my teens and early 20s. So if I could tell myself to just take an intro economics course, see how you like it, you might get into that later. That would be I think that would be very helpful.
Well, we just don't get taught those things typically, and they're so important. And really, whether it's economics or the basics of finance,
Mm-hmm.
just taking a couple courses along those lines for anyone, regardless what their future career might be, you can apply those topics in that education in your life, no matter what career you're ultimately in.
Absolutely.
What you've shared with us, I know has been very helpful for our audience, just getting that outsider's perspective on what retirement's all about. You've done the research, you've had your education, you've done your experience, and now you've been able to write about it and provide a lot of value to people that have been getting some very complex answers for years. And I'm going to have my fair share of complex guests here on the podcast. So it's nice to mix it up a little bit and offer some really common sense advice that everybody could use. Now, Emily, if someone wanted to reach you, if they wanted to get in touch with you, if they wanted to get to your blog, if they wanted to pick up one of your books, how could they make that happen?
So I have a website, emilyguybirken.com, and that's EmilYGuybirken.com. And you can also find me on Twitter, and my handle is at Emily Guy Birken. And I welcome any and all comments on Twitter.
Well, Emily, thanks for sharing. And you'd also offered that you'd like to get a couple signed copies of books out to people. I think we've got 5 books that we're able to do that with. So for the first of you that head on over to retirewithpurpose.com, we'll be able to get you a copy of Emily's book. She's willing to sign it, and she'd love to personalize it for you as well. Thank you, Emily, for coming on to the show, and I look forward to continuing our relationship in the future.
Great. Thank you so much.